beneficiary designations that bypass the clawback. Once title is set, you have to close the other on-ramps to probate. Lie. Only the house matters. Trap. One orphan account labeled estate can open probate and invite recovery. So our job is simple. Keep assets out of probate in legal ways your state allows, while staying clear of look-back traps. This is where beneficiary designations do heavy lifting. Start with bank and brokerage accounts. Use POD, payable on death, and TOD, transfer on death, to name who gets the funds. That means when you pass, the bank pays the named person directly. No probate, no court delay. In probate-only recovery states, this often shuts the door on a claim for those accounts because there's no estate asset to file against. In expanded recovery states, the state may still reach certain non-probate transfers. So we coordinate designations with your state's rules and your care program choices. Retirement accounts already use beneficiaries. Check them now. Name primary and backups. Use per stirpes if you want a grandchild to take a deceased child's share. Keep the tax angle clean by matching beneficiary types to the account rules. For IRAs, avoid naming the estate. That drags the account into probate, which invites a claim and can limit stretch options for heirs. Life insurance is next. Policies with named beneficiaries pass outside probate. That's good, but make sure the owner and beneficiary structure fits your plan. If the estate is the beneficiary, you lose the bypass and add claim risk. Fix that. Also confirm that premium payments are current and that the carrier has the right address and SSN for each beneficiary. Tiny admin misses send checks to limbo. For regular investment accounts, use TOD where offered. Some custodians call it transfer on death or beneficiary transfer. Same idea. Again, in probate-only states, this helps keep assets out of reach. In expanded recovery states, TOD may still be exposed if the state targets non-probate transfers. That's why we never rely on labels alone. We match the form to the statute where you live. Now, trusts. A revocable living trust is a great probate bypass tool for many assets. You title the account to the trust or add the trust as the TOD/POD beneficiary. On death, the trust instructions control the handoff without court. But remember, revocable trusts do not shield assets from Medicaid recovery by themselves because you still control them. The value here is clean transfer and court avoidance. In probate-only states, that can be enough to stop a claim. In expanded states, the law may allow claims against trust distributions or the trustee. So design and timing matter. What about irrevocable trusts? These can add protection if created and funded outside Medicaid's 5-year look-back and drafted to fit your state's rules. They trade control for safety. This is not a DIY move. If you need care soon, funding an irrevocable trust late can cause a penalty. If done early and correctly, it can move assets, including a home in some states, off the target path. Your POA must have express powers to create and fund trusts, or your agent can't do it for you if you're not able. Here's where forms fail. Generic POAs often cap gifting to customary amounts or past giving patterns. That blocks strategic moves. Your POA needs explicit authority to make gifts, including to the agent if your spouse is the agent, to create and fund trusts, to change or add beneficiary designations where allowed, to retitle accounts, to handle tax filings, and to manage real estate. In states like New York, that may include a separate statutory gifts rider. Without this detail, banks and custodians can say no right when timing matters most. Coordination is everything. If your deed passes the house outside probate, but one bank account still lists estate as beneficiary, that one orphan account can open probate. Once probate opens, recovery can jump in. So we map every asset: home, bank, brokerage, IRA, life insurance, annuities, vehicles, even prepaid burial accounts. Each gets a lane, deed, trust title pod/TOD, or beneficiary form. Then we verify backups. If a child predeceases you, does their share flow to their kids, or does it collapse to the other siblings? Decide now. Let's ground this with a quick case. Harold and June had a house, 2 IRAs, a joint bank account, and a small brokerage in Harold's name. They fixed the deed in Texas with a Lady Bird deed. Great start. Their IRAs had each other as primary, kids as backups. Clean. But the solo brokerage still flowed to estate. When Harold passed, that one account opened probate. The state filed a claim for June's HCBS ledger because recovery in their state runs through probate. The kids had to settle the claim before closing the estate, even though most assets were set. One form, big delay. Now flip it. Same assets, but the brokerage adds TOD to the trust. The joint bank account adds POD to the trust. The trust names kids per stirpes. On Harold's death, nothing hits probate. When June later passes, the house moves by Lady Bird deed. Accounts flow by trust and TOD/POD, and there is no estate to file against. In a probate-only state, that shuts the door. In an expanded state, we'd add program choices that avoid recovery or earlier trust design outside look-back. 2 last points. First, align titles with your care plan timing. Before any Medicaid waiver hour, finish your beneficiary sweep. Second, review yearly. Mergers, closed accounts, lost riders, and family changes break setups. A 20-minute annual check keeps you out of probate by accident. Get a 1-page map in the front of your file with every account, its lane, and the latest statement date. Simple, boring, the program
Safe.
line. That's how you
Medicaid
bypass
versus
the waivers versus VA aid and attendance. Now we choose lanes. 3 programs shape the path: Medicaid long-term care, Medicaid HCBS waivers, and VA aid and attendance. Lie. All help dollars are the same. Trap. Medicaid waivers can create a recovery ledger at 55 plus. VA pensions do not. Get this right, and you buy clean dollars and time. Medicaid long-term care covers nursing homes and, in many states, in-home help through waivers. The trigger that matters for estate recovery is age 55 and receipt of HCBS or institutional services. If you're 55 plus and get waiver hours, your state starts a ledger. Later, they try to collect. In probate-only states, they file against probate assets. In about 24 expanded recovery states, they can reach some non-probate paths too. That's why title and beneficiary work must happen before any waiver hour starts. HCBS waivers are the quiet trap because they look small. A few 8 hours, some adult day health, maybe transportation. Helpful? Yes. But if any of it is paid under a Medicaid waiver after 55, it lands on the ledger in expanded recovery states that can put even a transfer on death deed or some trust pathways in reach at death. Waivers are great when used with the right paper. They are risky when used first with no setup. VA aid and attendance is different. It's a needs-based pension for wartime veterans and surviving spouses. It helps pay for care at home, in assisted living, or in a facility. 2 key points make VA a strong first dollar. The look-back is 3 years, not 5, and there is no estate recovery on VA pensions. That means if you qualify, VA funds do not create a clawback later. Clean money, but the VA will still review transfers in the 36 months before you apply and can impose a penalty period capped by VA rules if you moved assets to qualify. You can often cure a VA penalty by reversing the transfer within 60 days of the decision. Timing and records still matter. So why not always start with VA? 2 reasons. First, not everyone served during a qualifying wartime period or meets the medical need. Second, even if VA fits, you must coordinate with Medicaid so the VA income and unreimbursed medical expenses stack correctly. Done well, VA can reduce your private spend and delay or limit Medicaid waiver use. That buys you time to lock deeds, fix beneficiaries, and complete safe spend downs like roof, ramps, rails, HVAC, dental, vision, and hearing. Let's draw the look-back lines on one page. Medicaid has a 5-year look-back for long-term care eligibility. Any gift or below-market transfer in those 60 months can trigger a penalty. The penalty is a time period you must private pay before benefits start. VA has a 3-year look-back starting from your application date. Transfers inside 36 months can trigger a penalty, but you have a short window to undo them after the VA decides. Different clocks, different cures. Your plan should use the shorter VA clock first, when possible, then step carefully into Medicaid only after your paper and spending order are clean. Here's the $1,000 per month mistake. Families skip VA and pay an extra $1,000 a month out of pocket for 10 years. That's $120,000 gone, often the exact amount they hope to leave the kids. In many cases, a VA pension could have covered that gap with no estate recovery risk. Missing VA is common because people think VA is only for service-connected disability or the forms are too hard. It's a pension for wartime service with financial and medical tests. Learn it, use it, or get help filing through VA-accredited representatives. Mixed coverage is where traps hide. Say you're getting VA aid and attendance, and then accept 1 hour a week of Medicaid waiver help. That 1 hour can open the estate recovery door in an expanded state. Your VA funds remain clean, but the Medicaid waiver hours start a ledger. If your title and beneficiaries aren't ready, you've turned on the claim path. The fix is sequence. Finish deeds, beneficiaries, and safe spend downs first. Use VA to bridge. Bring in Medicaid waiver. Help only after the paper is right, and only if your state's recovery lane is mapped. 2 more timing notes. In some places, community Medicaid look-back rules for in-home care are being phased in or delayed. Don't bank on delays. Plan as if the 5-year rule applies. Also, for married couples, Medicaid's rules allow a community spouse resource allowance. That means you can often keep more assets for the healthy spouse while qualifying the spouse who needs care. But you still need a POA with gifting and trust powers to shift assets fast and clean. Generic forms block the moves. Let's anchor this with a quick path you can copy. Step 1. Check Virginia eligibility. If service dates and medical need fit, prepare a clean application with a care plan and unreimbursed medical expenses documented. Step 2. While VA is pending, update POA with explicit gifting authority, trust creation, and funding real. Estate powers and beneficiary change powers where allowed. Add HIPAA releases. Step 3. Map your state's recovery lane. If you're in Florida, Texas, Michigan, Vermont, or West Virginia, record a Lady Bird deed before any waiver services. If not, use TOD or trust plus beneficiaries as your bypass in probate-only states, or consider early irrevocable trust planning if you are in an expanded state and have the time window. Step 4. Finish safe spend downs with receipts. Then, only then, evaluate Medicaid waivers. That's the program line. Use VA first when you can for clean dollars, respect the 5-year Medicaid clock, and never start a waiver hour until your paper and spending order are locked. Now we move to the spend order that keeps the house safe. The spending order that keeps the house safe. Once you know your state lane and you've picked the right program order, the next lever is how you spend. The goal is simple. Use dollars that do not trigger look-back trouble, raise safety at home, and reduce monthly burn before you ever touch a waiver hour. Done right, this order buys years at home and keeps the house off the claim path. Start with a safe spend-down ladder. Foundation first. Safety, mobility, and home access. These are not extras. They cut falls, cut ER runs, and cut night aid needs. Prepay essentials you'll need for the next 5 to 10 years. Roof, HVAC with clean filters, water heater, electrical fixes, grab bars, handrails, brighter LED lighting, non-slip flooring, door levers, widened doorways, and a zero-step entry or ramp. Each ties to care and health. Each needs an invoice and a receipt. That paper trail matters. Next, mobility. Replace the clunker car if driving is still part of daily life or caregiver support. A reliable car reduces missed appointments and prevents the emergency ride that becomes a hospital stay. Add a stair lift or transfer aids if needed. Fund a medical alert system with fall detection for a full year. These are valid medical and safety spends in most states and are far better uses of dollars than letting cash sit and then vanish into hourly care at peak rates. Now health capacity. Dental, vision, and hearing fixes are high ROI. Bad teeth become infections. Poor vision and poor lighting cause falls. Hearing loss drives confusion and isolation, which pushes behavior issues and night wandering. Schedule a full dental plan, new glasses, and hearing aids with fitting and batteries. Pay for them now, keep the receipts, and log the medical need. These costs are often allowed, and they reduce care hours later. Then, care hours. After you've built the safety stack, you can buy targeted help. The trick is to reduce agency load while keeping quality. Anchor the week with professional shifts when tasks are complex, bathing days, transfers, medbox setup, and have family cover lighter tasks where safe. That hybrid staffing cuts the bill while holding standards. If nights are the risk, don't jump to a 7-night aid. Layer cheaper tools first. Motion lights, bed pads, door chimes, camera-free sensors, and timed check-ins. One well-placed tech stack can delay costly overnights for months or years. Adult Day Health is a strong lever. It bundles meals, therapy, social time, and nursing oversight. For caregivers, it's respite. For budgets, it replaces several aid hours with one service line. If the program is private pay or VA offset first, use that path to avoid opening the Medicaid waiver ledger too early. Keep transport receipts if you're paying for rides. Those costs can count as unreimbursed medical expenses under VA and help qualify or raise the benefit. Every dollar needs a receipt trail and a care reason. Build a simple care log. Date, task, who did it, and time spent. Match big purchases to the care plan with short doctor letters. Requires rail installation due to fall risk. Needs hearing aids for medication compliance. And so on. When reviewers ask, you hand them a clean packet. You are not gifting. You are paying for care and health. That turns questions into approvals. Here's where most people mess up. They gift to kids first to be safe. Under Medicaid's 5-year look-back and VA's 3-year look-back, those gifts can cause a penalty period. A penalty means you must pay privately for a number of months before coverage starts. If you're already deep into care, that can be ruinous. Skip gifting to kids inside those windows. If you must help a child, document real services they provide and pay fair rates with invoices, a care contract, and logs. Even then, expect scrutiny. Clean is key. Another common error, spending after you've started waiver services. In many states, once the waiver is open, reviewers look harder at any asset moves. Do the big home upgrades and equipment buys before you apply for Medicaid waivers. If decline has already started, prioritize safety upgrades over transfers. A ramp now does more to keep you home than a deed change you cannot. Use without a solid POA. Sequence matters. The clean order is deeds and beneficiaries first, then safe spend down with receipts, then apply to the right program for your state and case. If you are married, add the community spouse rules. You may be able to shift assets to the healthy spouse within program limits without penalty, but you still need a POA with explicit gifting authority and real estate powers to do it fast and right. Without those clauses, you stall. Let me show you the stack at work. Ellen had $280,000 and a home before any waiver hour. Her agent used a strong POA to record a Lady Bird deed in Michigan, prepaid roof and HVAC, installed ramps and lighting, bought a stair lift, handled dental and hearing, and set a med sink with a weekly pill box. They documented every item with receipts and a doctor note. Then they used VA aid and attendance to cover part of her adult day health and a weekly pro-bath shift. Agency hours dropped from 40 to 18. Burn fell by half. When Medicaid waiver help started later, the ledger ran, but the house stayed off the lane. 2 years of runway turned into 5. This spending order is boring by design. It's checklists, invoices, logs, and timing. But it's also what turns a fragile budget into a stable plan. Build the safety stack, then buy hours. Keep paper for every dollar. Avoid gifts inside clawbacks. And never open a waiver until title and beneficiaries are set. Once your money is flowing in the right order, the next move is to shape the care plan that stretches your runway even further.